Welcome to this deep dive on the hidden risks inside non-governmental 457B plans and other non-qualified deferred compensation plans. First, we will explain the critical difference between these plans and typical qualified plans like 401ks and 403bs. Then, we will show you how assets in a non-governmental 457B are unsecured and what that means in a bankruptcy scenario. Next, we will unpack the irreversible distribution rules, discuss exit timing, and outline an action plan. Finally, we will test your understanding with quick quizzes and wrap up with key steps to protect yourself. Here is our roadmap. First, we will define what it means for non-governmental 457B assets to be unsecured. Second, we will examine bankruptcy risk and creditor claims. Third, we will address irreversible distribution rules. Fourth, we will consider exit timing. Fifth, we will lay out an immediate action plan. Sixth, we will outline tax impacts. Finally, we will conclude with key takeaways and next steps. Before we begin, please note this content is for education only. It is not tax, legal, or financial advice. Regulations and plan terms vary, and your situation may be different. Therefore, consult a qualified professional who is experienced with non-qualified deferred compensation plans and your jurisdiction before making decisions. With that established, let's proceed. Let's start with the core risk. In a non-governmental 457B, typically structured as an NQDCP, your deferrals remain the property of the employer until paid to you. This means the employer owes you money, but the funds are not segregated in a protected trust. As a result, you are treated as an unsecured general creditor. If the employer goes bankrupt or liquidates, those assets can be claimed by creditors, and your deferred balance may be lost. By contrast, qualified plans like 401ks and 403b generally hold assets in a trust separate from the employer's assets, which is a crucial protection. In short, you deferred wages rather than contributing to a protected account. Now let's compare structures side by side. Side by side, the distinctions are stark. On the non-governmental 457B side, assets remain the employer's property, leaving you an unsecured creditor. Rollover options are limited, and distribution elections are often locked in. Most importantly, payouts depend on employer solvency. On the qualified plan side, assets are usually held in a segregated trust, with broader rollover options and protections from employer creditors. With this context, let's visualize the risk flow. This flowchart depicts the life cycle of deferred compensation in a non-governmental 457B. First, the employee elects to defer income. Then, the employer records a bookkeeping entry rather than funding a segregated trust. Next, the employer retains the assets as general corporate assets. At the decision point, if the employer stays solvent, payments follow the predetermined distribution schedule. However, if the employer files for bankruptcy, creditors assert claims against the general assets, and the employee, as an unsecured creditor, may face partial or total loss of the deferred balance. This diagram highlights that the primary risk driver is employer solvency. Next, let's discuss access and payout rules. Generally, you cannot access non-governmental 457B funds until separation from service. Moreover, the distribution form you elected, such as lump sum versus installments, is often irrevocable and subject to strict timing rules designed to prevent last-minute changes. Informally, these guardrails are sometimes associated with the post-Enron regulatory environment, including anti-acceleration principles. Rollovers are typically very limited, often only into another non-governmental 457B. Consequently, if you suspect employer instability, waiting to separate may increase the risk that your balance is exposed to creditor claims before you can access it. Now, let's check your understanding with a quick question. Question: if your employer declares bankruptcy before you separate from service, what is the status of your non-governmental 457B balance? Options: A. Fully protected in a trust, untouchable by creditors. B. Treated as an unsecured corporate asset, potentially available to creditors. C. Automatically rolled into your 401(k)(d). Frozen but guaranteed by the PBGC. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is B. Non-governmental 457B assets are generally employer assets, so in a bankruptcy scenario, creditors may have claims against them. This is the core risk of unsecured deferrals. Now let's move to concrete steps you can take. Here are immediate steps to reduce risk. First, obtain the official plan document from HR and avoid relying on verbal assurances. Second, identify your distribution triggers and understand whether your elections are irrevocable. Third, work with a tax professional to model the tax implications of lump sum versus installment distributions. Fourth, evaluate your employer's financial health and weigh the trade-off between job continuity and the potential loss of deferred savings. Fifth, if the risk appears elevated, consider securing new employment to trigger separation and access to funds. Sixth, record your decisions and track relevant election deadlines. Next, let's detail exactly what to look for in the plan document. Use this checklist as you review the plan. Verify distribution triggers, including separation from service and any other allowed events. Review the form of payment section to understand whether your election is irrevocable and how payments are scheduled. Investigate any references to a rabbi trust or similar structure, and read the fine print on whether it truly protects assets and under what conditions. Confirm rollover options and their limitations. Examine change election rules to see how and when adjustments are permitted. Finally, check forfeiture or clawback provisions that could reduce or eliminate your balance under certain conditions. Next, we will cover the tax impact of distributions. Turning to taxes, distributions from non-governmental 457B plans are generally taxed as ordinary income in the year paid. A large lump sum can elevate your marginal tax bracket. Installments can spread taxation, but also extend exposure to employer risk if payments depend on ongoing solvency. Coordinate withholding and estimated payments to avoid penalties, and work with a specialist experienced in NQDCP taxation to model scenarios. Now, let's visualize your decision process with a second diagram. This state diagram starts at being employed and moves to evaluating employer risk. If risk is low, the path suggests remaining employed and eventually receiving scheduled distributions upon separation. If risk is high, the path prioritizes seeking new employment to trigger separation and access to funds. There is an explicit branch showing bankruptcy before separation, which leads to creditor claims and potential loss. The diagram also indicates that the chosen distribution method is often irreversible, reinforcing the importance of selecting a strategy deliberately. With that in mind, let's check your understanding again. Question: which rollover is typically allowed for non-governmental 457B assets upon separation? Options: A. To any IRA. B. To a 401k at your new employer. C. Only to another non-governmental 457B, if permitted. D. To a Roth IRA without current taxation. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is C. Rollover options for non-governmental 457B plans are generally limited to another non-governmental 457B, and this depends on both plans' rules. This constraint reinforces the need to carefully plan exit timing and distribution elections. Next, let's cement today's key takeaways. To summarize the essentials: non-governmental 457B balances are unsecured employer obligations and exposed to creditor claims. Access typically requires separation, and distribution choices are often locked in. If bankruptcy occurs before separation, your balance may be at risk. Rollover options are limited, which complicates mitigation. Therefore, obtain the plan document, consult specialists, and make timely, informed decisions. As we wrap up, your next steps are straightforward. Request your official plan document, identify distribution rules and deadlines, and model taxes for potential payout strategies with a qualified professional. Reassess your employer's financial health and consider the timing of separation if risks are rising. Finally, document your plan and track key dates. Now, let's close with a quick thank you and a call to action. Thank you for watching. If you found this valuable, please like the video, share it with colleagues who may be exposed to similar risks, and subscribe for more insights. Share your questions and experiences in the comments, and let us know how you plan to protect your non-governmental 457B savings.